Okay, today we're going to talk about Chapter 12, which covers capital budgeting decision criteria and some other things. Note that in this chapter and also Chapter 13, we will be talking about capital budgeting. But in this chapter, the difference is that the cash flows will be given to you. And all you have to do is determine whether the project is acceptable or not. In Chapter 13, you'll have to calculate those cash flows. So Chapter 13 is actually the more difficult chapter of these two. So what is capital budgeting? Well, it refers to the process of deciding how to allocate the firm's scarce capital resources to various investment alternatives. Always remember that capital is limited. And so the goal here is to decide where to best put that capital. In other words, what investments should we make that make the best use of our shareholders' money. Now, ultimately, what we're doing here is comparing costs and benefits, and we often refer to this as a cost-benefit analysis. So remember that the goal of the firm is to maximize shareholder wealth, and that means that we should only invest in projects that will increase shareholder wealth, or, in other words, we accept a project if the benefit exceeds its cost, or we will reject it if the benefit is less than the cost. Now, there's a little bit of a gray area when the benefit equals the cost, but as we'll see, in that case, we should accept the investment because of the way that we define the benefit. One other point here is that often we have to compare projects, or we have more than one project available to us, and we may have to compare them. If the projects are what we call independent, that means that if we choose one of them, it has no impact at all on our decision for the other one. On the other hand, if the projects are mutually exclusive, that means that if we accept one, we absolutely cannot accept the other one. So we have to pick the best of the two. Now, the methods that we're going to discuss here today have wide applicability. So, for example, in a corporate setting, we might use the capital budgeting methods to determine whether or not to launch a new product, or should we replace a piece of equipment with a newer piece of equipment that does the same job but more efficiently maybe. We may use these techniques to decide whether to buy a product that we're going to sell or to make it ourselves. We may look at, should we lease our headquarters building or should we buy it? Bond refinancing is another area. Does it make sense to issue new bonds to pay off old bonds? We use these techniques in mergers. Should we acquire another company? Does that make sense? And also corporate restructuring. Now, on a personal level, you can use these same techniques for numerous things, such as, does it make sense to refinance a mortgage? Does it make sense to get a college degree, or even better, to get a master's degree? In either case, you can expect that your salary is going to increase above what you had previously, but does it increase by enough? And that really ultimately is what we're trying to figure out here, because a lot of times you evaluate a potential investment and it will make you better off, but the question is, does it make you enough better off? And that's a key that people often overlook. We can use these techniques, again, just like we did in a corporate setting. Should you rent an apartment, or should you buy a house? And then also household improvements. For example, maybe you're thinking about buying a new furnace because the new ones are more efficient than the old ones. Well, the question to ask is that new furnace going to save you enough on your power bill so that it makes sense to purchase it? Maybe, maybe not. And these techniques can help you to figure that out. Now, in the mini case, they say that you just graduated from an MBA program and you're thinking about investing in two franchises. You have franchise L, which is Lisa's Soups and Salads and stuff, and franchise S, which is Sam's Fabulous Fried Chicken. And they give us the cash flows from each franchise, as you can see on the timeline that I've presented here. Now, a key thing to note, which will become important later on, is that franchise L starts out slow with low cash flows and they get bigger over time, whereas franchise S starts out with big cash flows and they tend to get smaller over time. This is ultimately going to lead to what we call a ranking conflict. So we'll see that later on. And then they tell us that you have a 10% required return for both projects. And the question is, should you accept franchise L or S or maybe both? There are 6 profitability measures that we're going to look at, and we'll go through each of them in turn here, but they are the payback period, the discounted payback period, net present value, profitability index, internal rate of return, and modified internal rate of return. And you should be at least a little bit familiar with all of these because you would have seen them in Finance 3300. So let's start with the payback period. The payback period answers the question, how long is it going to take to get my money back? So you make an investment, and then the natural question is, how long until I recover that investment and start making profits? Now, we will see that there's a couple of ways that we could calculate this. The simplest is if the cash flows are an annuity. In other words, if you get the same cash flow every year during the life of the project. In that case, it's very simple. We just take the cost of the investment divided by the amount of the cash flow, and that'll tell us exactly how long it's going to take to get the money back. Most of the time, though, you don't have annuity type cash flows, and so the calculation is a little bit more involved. We'll see that here in just a second. The idea of the payback is very simple. The quicker you get your money back, the better. Now, if a firm is using the payback period, which not that many of them do anymore. 50 years ago, this was the number one technique that firms used. Today, net present value and IRR are by far the most common techniques. But if a firm uses the payback period, typically they're going to have some maximum acceptable payback. So they might say, we'll take any project as long as it pays back within 3 years or some other number. Now, let's look at an example from the mini case. So recall that franchise L provided cash flows of 10, 60, and then 80. So to calculate the payback, we take our initial outlay, which is 100, and we simply start subtracting cash flows until we get to 0, or if we went one more step, we would be more than paid back. So we take our initial $100 investment minus the first year's cash flow of 10. That leaves us with 90 still to be recovered. Then we subtract off year 2's cash flow of 60. That leaves us with 30. And if we subtracted year 3's $80 cash flow, we would end up negative. So we know our cash flow is somewhere between 2 and 3 years. So what we do is we say, well, let's take that 30 that's left over after 2 years, divide it by the year 3 cash flow, and that tells us that it's going to take 3/8 of a year to recover that 30. So our total payback then is the 2 years we got initially plus the 3/8 or 0.375 years. So 2.375 years. Franchise S is even easier. Remember, with franchise S, the cash flows start out quite large and they get smaller over time. So with S, we take our initial $100 outlay minus the year 1 cash flow of 70. That leaves us with 30. And if we subtracted off the next 50, it would be negative. So we have 1 year plus some fraction of year 2. And that fraction is 30 divided by 50, or 0.6 years. So our total payback on franchise S is 1.6 years. So as you can see, the payback period is very easy to calculate. However, it has a couple of serious problems. First of all, it ignores the time value of money. Now, this is a cardinal sin in the world of finance. You cannot ignore the time value of money. So that by itself means that the payback period is not really a good method to use for capital budgeting. But secondly, it ignores any cash flows that occur after the payback period. So you can imagine if you have a project that has really large positive cash flows after the payback period, those are totally ignored, and therefore the project is going to look worse than it should. Now, there are a couple of redeeming qualities of the payback period. First of all, as I mentioned, it's quick and easy to calculate, and it's easy to understand. Secondly, it gives you a measure of the liquidity of the project and, in a sense, the riskiness of the project. So a project that pays back within 1 year, that's very liquid. You're going to get your money back very quickly. But you can also say that it's not very risky. So payback is not completely useless, but it should never be the primary technique that you use. Now, I mentioned one of the problems with the payback period is that it ignores the time value of money. So we can fix that actually pretty easily. All we have to do is calculate the payback period using the present values of the cash flows, discounted at our weighted average cost of capital. So if we do that, we end up with something that's known as the discounted payback period. Now, on the timeline that you see on the screen here, I've calculated the present values of each of the cash flows for both franchises, and you can see them shown here. And if we use the same exact technique to calculate the discounted payback period that we did for the regular payback period, except using these present values, you'll find that franchise L has a discounted payback period of 2.69 and S has a discounted payback period of 1.88 years. Even with the discounted payback period, S looks like the better project if we have to choose between them. Now, the problem with the discounted payback period is the same as with the regular payback period. That is, it ignores any cash flows that occur after the payback period. So this is potentially a serious problem because you may end up rejecting projects that have large cash inflows later on in the life of the project. So it may start out not looking very good, but it gets really good later on. You might reject that project. Alternatively, you might end up accepting projects that have large cash outflows in later years. So it might look good on a discounted cash flow basis, but because of those big cash flows in the later years, it might really be a bad project, but you might accept it because of the good discounted payback period. So any measure of payback can lead firms to focus on short-run profits at the expense of longer-term projects or profits. That's a real problem. Now, of all of the techniques that we're going to talk about, net present value, or NPV as we usually call it, is the best of them all. The NPV is a direct comparison of the benefit, defined as the present value of the cash flows, to the cost of the investment. And again, it's very simple. If the benefit exceeds the cost, we should accept the investment. So here in the formula, you can see the first term is the present value of the expected future cash flows, and the IO is the initial outlay. That's the cost of the investment. We'll talk about that more in Chapter 13, how to calculate the annual after-tax cash flows and the cost of the investment. But that first term measures the benefit, and the second term is the cost. So NPV is a direct comparison of the benefit to the cost. Note that your financial calculator, as we'll see in just a second, has an NPV function built into it. And I'm showing here for the TI 83 and 84 because that's what most people have. So if you press the Apps button and then number 7, well, in the Finance menu, that will bring up the NPV function. The NPV function takes a few arguments. The first is the weighted average cost of capital. So in this case, that would be 10. The second is the cost of the investment as a negative number because it's a cash outflow. The third is a list of the cash flows. And then the fourth is optional, but if you have cash flows that repeat, so for example, maybe you have $100 in year 1 and $100 in year 2 and $100 in year 3, you don't need to enter that 3 times. You could just put in 100, and then in the fourth argument, you tell the calculator that the first cash flow happens 3 times in a row. We're not going to use that a whole lot in this class, but it can be a real time saver when you need it. The decision rule for NPV is very straightforward. If the NPV is positive, that means that the benefit exceeds the cost. So you should take the investment. If it's negative, that means that the benefit is less than the cost and you should reject the investment. If the NPV is 0, that means that you should accept the investment because the benefit equals the cost. Now, understand that we're defining the benefit as the total present value of the cash inflows. And since we're discounting those cash flows at the cost of capital, an NPV of 0 means that the shareholders get exactly their required rate of return. And anytime you get exactly what you want, you should be happy with that. And so the shareholders will be happy with an NPV of 0 or greater. So let's look at an example. So in the mini case, we had 2 projects, and here you see project or franchise L. And remember, it had cash flows of 10, 60, and 80. So in the formula here, you see I'm taking the present value of the 10, present value of the 60, and the present value of the 80, and I add them together to get the total present value, and then subtract 100, and I end up with an NPV of 18.78. So on its own, franchise L is an acceptable project because it has a positive NPV. We do S exactly the same way. Present value of the cash flows, 70, 50, and 20, minus 100, which was the cost, gives us 1998. Note that both franchises have positive NPVs, so they're both acceptable. Now, on your calculator, and here you see the NPV function again. Remember, that's number 7 in the finance list. And you can see we give it our cost of capital, that's 10, comma, negative 100, comma, and then I create a list inside the calculator. That's what the curly braces do, so that you don't have to create a list separately. And in those curly braces, I simply put 10, 60, 80. Close out the curly braces, close out the parentheses, and I get 1878, which is exactly the same as what I got from the formula. Franchise S, we do it exactly the same way, only the cash flows are different, and you can see that we get 1998, which is the same again as we got from the formula. Now, sometimes it's useful to look at how the NPV changes if your weighted average cost of capital changes. One reason for this is because there's some uncertainty often about what the weighted average cost of capital is. Usually not a huge amount of uncertainty, so you might know, oh, it's somewhere around 10%, but it's probably not 25% or 30% or something like that. Nonetheless, it can be useful to draw a chart that shows the NPV and various discount rates. And so here you see the NPV profile for franchise L and also for franchise S, which is the red line. And so all I'm doing is recalculating the NPV at a whole bunch of different discount rates. Now there's a couple of key points here. First of all, notice where each line crosses the x-axis. That's the point at which the NPV equals 0. We call that discount rate that makes the NPV equal to 0 the internal rate of return, or the IRR. We'll see that in just a second. Secondly, notice that there's a point, in this case, not always, but in this case, there's a point at which the two lines cross each other. And remember from your math classes, anytime you have two lines that cross, there's something interesting going on there. And in this case, the interesting thing is that at that discount rate, the NPVs are equal. And we'll see that that discount rate is 8.68%. Notice that below an 8.68% weighted average cost of capital, franchise L has a higher NPV. So if your cost of capital is low, franchise L looks like the better project. But if your cost of capital is higher than 8.68, then franchise S is the better project. So which project is better depends on the level of your cost of capital. Now, we haven't talked about the IRR yet. We'll get to that in just a second, but you can come back and look at this. So to calculate that crossover rate, all you do is you find the internal rate of return of the difference between the cash flows. So in this case, they both cost 100. So in year 0, 100 minus 100 is 0. In year 1, if we take franchise L minus franchise S, we have 10 minus 70 gives us negative 60. In year 2, we have 60 minus 50 gives us positive 10. And in year 3, we have 80 minus 20, which gives us positive 60. So if you calculate the IRR of those differences, you get the crossover rate, which is 8.68%. Now, the profitability index is very similar to the net present value. However, with the net present value, remember we took the benefit, present value of the cash flows, minus the cost of the investment. So it was the difference that we were looking at. With the profitability index, we're dividing the benefit by the cost. In other words, it is a ratio of the benefit to the cost. So again, the benefit is the present value of the future cash flows. The cost is the initial outlay. So again, the idea is that we accept projects where the benefit exceeds the cost, and that means that the profitability index is greater than or equal to 1. Now, there is no built-in function on your calculator for profitability index. However, remember, all we want here is the present value of the cash flow. So we're going to tell the calculator that our initial outlay is 0. that will give us the present value of the cash flows. So you take the NPV function, divide that by the initial outlay, and you get your profitability index. And here you can see both projects on the calculator exactly as I've described. So for franchise L, we get 1.188 basically, and for franchise S, we get 1.2 essentially. So both of these have profitability indexes that are greater than 1, therefore they're both acceptable. Now, the internal rate of return is right up there with net present value as a popular decision measure. And what it tells us is the discount rate that makes the net present value equal to 0. Or another way to look at it is the IRR is the compound average annual growth rate that you expect to earn if you make the investment. The nice thing about this is that because it's a percentage, we can compare it directly to the weighted average cost of capital. And the decision rule is if the IRR is greater than or equal to the weighted average cost of capital, we should accept the investment. Now, one of the problems with the IRR is that there is no formula to solve for it directly. Instead, we have to use a trial and error process. And you can see in the formulas here the way that we set this up. We have the initial outlay on the left, and we set that equal to the present value of the cash flows, but we have to find that discount rate. Except in the most trivial of cases, such as when you only have one cash flow, you cannot just solve directly for the IRR. Instead, you have to do something like, let me try 10% and see if that works. And if that doesn't work, let me try 9 or 11 or some other rate until you find the discount rate that makes the present value of the cash flows equal to the initial outlay. Now, fortunately, you rarely have to do this by hand. Your calculator or a spreadsheet will be able to do it for you. And the calculator has a built-in IRR function that's almost identical to the NPV function, except, of course, we don't give it a discount rate because that's what we want to solve for. So you can see that function here. The first argument is the initial outlay as a negative number, followed by a list of the cash flows, and then optionally followed by a list of frequencies. Again, the frequencies of the cash flows do not have to be given if they all only happen one time each. So on the images of the calculators here, you can see for franchise L, I have IRR, which is number 8 in the finance list. I have IRR, and then in parentheses, negative 100, comma, and then in curly braces, 10, 60, 80. Press enter, and you get 18.125, etc. Now, remember that the cost of capital is 10%, so franchise L has an IRR that exceeds the 10% cost of capital, therefore it's a good investment. Similarly, for franchise S, we do the same thing and we get 23.56%, which also exceeds the cost of capital. So both of these projects, again, are acceptable. Now, the IRR does suffer from some potentially serious problems. Most of the time, these are not real problems that you have to worry about, but sometimes they are, and so you need to be aware of these. First of all, the IRR implicitly assumes, that means you don't explicitly do this, but it's built into the way that it's calculated. It implicitly assumes that the cash flows get reinvested at the IRR. So imagine that you someday find a really good looking investment. It's going to return 80% per year or some ridiculously high number. There's almost no way that you're going to be able to reinvest the cash flows at 80% per year. And so in that case, the IRR would be overstating what your true average annual rate of return is. Secondly, when we have non-normal cash flows, and we'll see an example of that later on, but non-normal simply means that there's more than one sign change in the stream of cash flows. So you go from positive to negative and back to positive. That's a sign change. Actually, that's 2 sign changes. And so that creates a problem because then you can have multiple IRRs. And as we'll see, they'll be mathematically correct, but economically meaningless. And then finally, sometimes percentages can be misleading. So the example that I have here, would you rather earn 100% on a $100 investment or a 10% return on a $10,000 investment? Well, clearly you'd rather have 10% of 10,000 rather than 100% of 100. And that makes the point that ultimately what matters are the dollar values, not percentages. Now, in part J of the mini case, they give us an example of non-normal cash flows. So you're considering a pavilion at the World's Fair. It would cost $800,000 and result in cash flows of $5 million in year one and negative $5 million in year two to demolish the site. So notice that we go from a negative $800,000 to $5 million. That's one sign change. And then we go from $5 million to negative $5 million. That's a second sign change. So according to Descartes' rule of signs, that means that there are potentially two IRRs in this case. Now I say potentially because that's not always true, but it could be up to two. And in fact, in this case, we do have two. So now we want to know what's the NPV, the IRR, and then something else we'll talk about in a second, the modified IRR. And we also want to draw the NPV profile. So here's the cash flow timeline, and you can see negative $800,000 to $5 million, that's one sign change. And then $5 million to negative $5 million, that's a second sign change. And if we draw the NPV profile chart, which you can see is the blue line here, notice that it behaves oddly. If you recall earlier, we had the NPV profiles for L and S, and they were both curves, in other words, convex functions, but they were monotonic. They never changed direction. They always went down as the cost of capital went up. In this case, you see that the NPV initially rises as you increase the cost of capital. That's unusual, and that's because of the negative $5 million out there. When you discount negative numbers, you start getting some weird results. So it rises initially, crosses the x-axis, that's one IRR, and then it begins a gradual decline, and ultimately it crosses the x-axis again. So there are two IRRs. In this case, they're 25% and 400%. Now let me note that your calculator will give you the 25%, but you have to find the 400% on your own. And the way I do it, if I know that there probably are multiple IRRs, is I simply set up a table in a spreadsheet with a whole long list of potential costs of capital, and I find the NPV at each one. And then I look for where the NPV is 0, and I know those are my IRRs. Now, here's the NPV calculation for Project P, this World's Fair Pavilion. Using the calculator, you can see that it's negative $386,776.86. So since the NPV is negative, we know right off the bat that this is a bad investment. It should not be accepted. We can also calculate the IRR using the IRR function, and you can see, again, in this case, the calculator tells you it's 25%. It does not tell you about the 400%. And then we haven't talked yet about modified IRR. We will next. But the modified IRR is negative, which confirms that we should not accept the investment. So you can come back to this after we talk about modified IRR and see how to do that calculation. So as you might guess, the modified IRR is in fact a modification of the IRR, and specifically the modification is that we assume a reinvestment rate equal to the cost of capital rather than a reinvestment rate equal to the IRR. Remember, the IRR assumes that you're going to reinvest those cash flows at the IRR. And that, by the way, is why you cannot calculate the IRR directly. In order to calculate the IRR directly, you would have to know the reinvestment rate. But the reinvestment rate is the IRR, which you don't know. So the modified IRR allows us to assume that the weighted average cost of capital is the reinvestment rate. Therefore, we can, in fact, calculate it directly. Specifically, this is more of an algorithm than a formula, but specifically, what we do is we first find the total future value of the cash flows, and then we have an initial outlay, that's our cost. We have a total future value, and we want to solve for the rate that equates those two, the discount rate that equates those two. So to do that, we take that future value of the cash flows, divide it by the initial outlay, That gives us 1 plus the total return over the life of the project. And then we take the nth root of that and subtract 1, which gives us the compound average annual growth rate, assuming that we reinvest at the cost of capital. You're usually not going to use this formula, at least not directly, because spreadsheets have a built-in MIRR function. Your calculator does not, however. And so on the calculator, you do have to use this formula. So to find the future value of the cash flows, we first find the present value using the NPV function with the initial outlay set to 0, and then we find the future value of that by multiplying it by 1 plus the weighted average cost of capital raised to the nth power. N is the number of periods in the life of the project. So the numerator here is the future value of the cash flows. Divide that by the initial outlay, and then raise that result to the 1 over n power and subtract 1. Now, that seems complicated, but if you do it a few times, it's not that bad. So here on the calculator, you can see how I've done franchise L. So the first thing is we use the NPV function with the initial outlay set to 0 to find the present value of the cash flows, and then multiply that by 1 plus the cost of capital, which is 10% here, and we raise it to the third power because franchise L is a 3-year project. That gives us a present value of 158.1. And then we take that result and we divide by the $100 initial outlay, raise that to the 1/3 power, and subtract 1, and we get 16.4958%, or we'll just round that up to 16.5. For franchise S, we do exactly the same thing, except of course we use the different cash flows, and here you can see that, and we get 16.89%. So if you'll recall, franchise S had a little bit higher NPV than franchise L, and we see the same thing here. S has a higher MIRR than L, and so if we had to pick between L and S, S would be the better choice. However, remember that S had a lower IRR than L did. And so that's what we call a ranking conflict. When NPV and IRR disagree on the best project, that's a ranking conflict. Modified IRR will almost always agree with the NPV. So instead of using the regular IRR, you're better off usually using the modified IRR. Now, sometimes in capital budgeting, you run across some problems. Or they're not really problems, but they're things that you might have to deal with. And so we'll look at 3 here. That is unequal lives, making inflation adjustments, and finding the optimal economic life of an investment. So let's start with the unequal lives problem. So in this case, in part K, they tell us that we have 2 projects, T, which is a 2-year project, and F, which is a 4-year project, and you can see their cash flows on the timeline here. Now, because they have different lives, we cannot directly compare the NPVs or IRRs or modified IRRs of these 2 projects. So what we have to do is somehow make it so that they both have the same life. Now, if we start out by calculating the NPVs of these 2 projects, we'll find that Project T has an NPV of $4,132 and Project F has an NPV of $6,190. So it looks like F is the better investment, but remember, F is a 4-year project, T is a 2-year project, so we can't really compare these NPVs. So the way to think about this is that if we have a 4-year project that we're considering, that means our investment horizon is at least 4 years. So what we're going to do, or one way that we can do it, is we can make Project T into a 4-year project, and we'll see that in just a second. But essentially, we have 2 ways of dealing with this. We could use the replacement chain approach or the equivalent annual annuity approach. So with the replacement chain approach, what we do is we simply repeat each project as many times as necessary until they both have the same life. So in this case, Project T was a 2-year project and F was a 4-year project. So if we do T once and then repeat it, that's a 4-year investment. And so the red cash flows on the timeline here are where we're repeating Project T's cash flows. So ultimately what we have to do is calculate the least common multiple of the lives of the two projects that we're comparing. So for example, if you have a 3-year project and a 4-year project, you would have to repeat them both until they have a 12-year life, because 12 is the lowest common multiple of 3 and 4. Now, if we look at that timeline again, notice in year 2, we have a $100,000 outflow and a $60,000 inflow. So the net cash flow in year 2 is negative $40,000. So if you plug that into your calculator and calculate the NPV, you'll find that the 4-year NPV for Project T is $7,547, which is greater than the NPV of Project F. Therefore, Project T is actually the better investment. Now, the equivalent annual annuity approach it seems like it's a little bit more complicated, but it's actually less work to calculate it once you understand the technique. So the steps are this. First of all, we calculate the NPVs for both projects, and we've seen that. We have 4132 for T and 6190 for F. So that's just the regular NPVs. And then we're going to plug the NPV into the calculator as the present value. N will be the life, and the cost of capital is your I%, and then we solve for the payment. You can see that here on the calculator on screen for Project T. We get 2,380.95. Now, when we do the same thing for Project F, and notice here that N is 4, whereas for Project T, N was 2, because N is the life of the projects. We plug in the PV or the NPV as PV, and we get a payment of $1,952. So the equivalent annual annuity for T is $2,380, and for F, it's $1,952. So that means that T is the better investment. Now, we also have to deal with inflation. Generally speaking, inflation is going to be positive, and that means that when we estimate our cash flows, we need to make sure that we build in that positive expected inflation rate. Otherwise, we will understate the cash flows, which means we'll understate the NPV, and we might end up rejecting the project. So recall the Fisher relationship. It says that the nominal rate of return is equal to 1 plus the real rate of return times 1 plus the inflation rate minus 1. The point here is that the cost of capital is a nominal rate of return. That means that it already has expected inflation built into it. So therefore, if we have real cash flows discounted at a nominal rate of return, we're going to understate the NPV. And that'll make the project look worse than it should. So sometimes it's easier to forecast real cash flows, in other words, current day's cash flows, but then later go back and adjust them upwards to account for inflation. And you can see all we have to do is take that cash flow times 1 plus the inflation rate to the nth power, where n is simply the number of the period in which the cash flow occurs. Now, in some cases, it may be better to abandon a project before its useful life is up. And in this case, in Part L, they give you an example. So we have a project that's going to provide cash flows of $5,000 in year 0. That's negative $5,000. $2,100 in year 1, $2,000 in year 2, and $1,750 in year 3. But then they also give us the salvage value. So if we sell the project before its life is over, we're going to get some money back. And so what we can do is calculate the NPV for each year of the life of the project, assuming that we abandon it in that year. So if we abandon it immediately after buying it, you can see in the last column of the table, the NPV would be negative $454.55. So clearly that wouldn't make sense. If we abandon it in year 1, we'll have spent $5,000 to get $2,100 plus $3,100. And that gives us an NPV of negative 272.73. So still a negative NPV, so it does not make sense to abandon it after 1 year. And then if we abandon it after 2 years, we spend $5,000 and we get $2,000 and $2,000 in year 2, and also, of course, the $2,100 in year 1. And that gives us an NPV of $214.88. So that would make economic sense to purchase the project, hold it for 2 years, and then sell it. If we hold it for the entire 3-year life, we end up with a negative 123.22 NPV. So in this case, the highest NPV is achieved by holding the project for 2 years and then abandoning it. So that is the economic life of the project. It's 2 years. The useful life apparently is 3 years. Okay, that's my lecture for Chapter 12. We'll continue on with a quick look at the mini case. Okay, so I'm going to take a pretty quick look at my spreadsheet for the mini case. We've really already gone over most, if not all, of the calculations. And so the spreadsheet simply serves to remind you how those are done. We'll recall what we have here is we have 2 franchises that you're interested in purchasing, franchise L and franchise S, and you can see the cash flows from both of those. And then down here we have the required returns, and remember they have the same amount of risk and therefore they have the same required return. And then we calculated the payback period for both of them, and you note that franchise L takes longer to pay back than S does, and therefore S is the better investment if you had to pick between L and S. The discounted payback period, recall we use the present values of the cash flows, and you can see those in columns D and E, and those match the numbers that I gave you in the lecture. And again, L has a higher discounted payback period than S does, as typically you would expect. Now, we also have the net present value, 1878 for L and 1998 for S. So at a 10% discount rate, S looks better than L. However, note that if we had a lower discount rate, recall from the lecture we calculated the crossover rate was 8.68%, and you can actually see that right here. If we calculated the NPVs with, say, a 5% rate or any rate below 8.68%, then L would have a higher NPV than S. And so which project you choose depends on your cost of capital. In this case, if it's lower than the crossover rate, we would pick L, and if it's higher than the crossover rate, we would pick S. And it just so happens that the cost of capital is 10%, which is higher than the crossover rate, and that's why S is the better investment here. We also were asked to calculate the profitability index, and remember that's the present value of the cash flows divided by the initial outlay. And in this case, essentially what that's telling us is that we're going to get back $1.19 in benefits on franchise L for every $1 that we invest. And remember that the benefit is the present value of the cash flows. So this is in present value terms. For franchise S, we would get back $1.20 for every $1 invested. And so S, it looks like the better project, again at a 10% discount rate. If we change the discount rate to be something below 8.68%, then L would be the better project. The IRR, recall, is the compound average annual rate of return on the project, assuming that you reinvest the cash flows at the IRR. And you can see here we have 18.13% versus 23.56%. So according to the IRR, S is the better investment. Now note that the IRR will not change if your cost of capital changes. So unlike the NPV and the profitability index and even the modified IRR, the IRR is just a function of the cash flows. And therefore, no matter what, these IRRs are not going to change. Well, unless we change the cash flows. So S has a higher IRR. Therefore, if these two projects were mutually exclusive, we would choose S. The modified IRR, remember, is basically the same idea as the IRR, except that we assume that we're going to reinvest the cash flows at the weighted average cost of capital. That's the same assumption that the NPV makes. And in this case, we see that S has a higher modified IRR than L does. Now, also, we had project P, which was the project that had non-normal cash flows, and it was a pretty bad investment. I mean, even without doing any calculations, you should be able to see that this investment doesn't make sense. I mean, after all, ultimately you're investing about $5.8 million to get back $5 million. So clearly that's not a good investment. And we can see that. We calculated the NPV. It was negative $390-some thousand. Profitability index was way below 1. But remember that the IRR looked really good. We had 25% and 400%. And just to show you, because I mentioned in the lecture that I calculate those IRRs by setting up a big table in Excel. Okay, and there you go. So you can see at 25% the NPV is 0, and at 400% the NPV is also 0. And if you plot that, you're going to get that NPV profile chart to the right. Now, the modified IRR, in your textbook, they give you one way to calculate it. And this has to do with the negative cash flows. So in the way that they tell you to do it in the book, you find the present value of all the cash outflows and the future value of all the cash inflows, and then you use the equation that I gave you. If you do that, and this, by the way, is the common way to do it. I think it's wrong, and I'm not the only one, but I think it's wrong, but you get 5.6%. Now, that means, because the cost of capital is 10%, that you would reject this project. But I think a more meaningful number is what you get if you do it the way that I told you, which is you find the future value of all the cash flows after period 0, divide that by the initial outlay, and then take the nth root, in this case the square root. If you do that, you get negative 20.94%. And I think in most cases, this is going to give you a number that makes more sense, and you can see that here because you get a negative rate of return. And with these cash flows, I think it's pretty obvious that the true rate of return that you're going to earn is negative. You're losing money after all. Now, next we had Project T, which was a 2-year project, and Project F, which was a 4-year project. And you'll recall that we can't compare those directly. We have to somehow come up with a way that we can compare apples to apples. And so we looked at 2 ways to do that. The first way was to convert Project T into a 4-year project by repeating it 1 time. This is what's known as the replacement chain approach. And if we do that, then we see that its NPV is $7,547, which is higher than the NPV of F. The alternative, which will almost always give you the same answer, is the equivalent annual annuity method. And in that case, remember that we took the NPV that we calculated, and that becomes the present value. N is the life of the project, and the interest rate is the cost of capital, and you solve for the annuity payment. So effectively, what this gives you is how much of an annuity could you purchase with the NPV. The higher equivalent annual annuity gives you the better project. And in this case, it's Project T, which is the same thing that we found using the replacement chain approach. And then finally, we had this project at the end where we were looking at the abandonment value. So we calculated the NPV if we abandoned it immediately, or after 1 year, or after 2 years, or after 3 years. And what we found was that the optimal life of the project, the economic life of the project, was 2 years. So I hope that you found that helpful. Remember that this spreadsheet is available on Blackboard, so you can download it and check your numbers. All right, I will see you next week with Chapter 13.